Folks, listen up. What if I told you that you could beat those fancy Wall Street bigwigs at their own game? And what if I told you the secret was to actually do less? That's right. Less trading, less stressing, less paying outrageous fees to people who often don't even beat the market themselves. It sounds too good to be true, I know. But today, we're diving into a way of investing that's all about common sense. It's about keeping things simple and letting your money work for you, not the other way around. Wall Street loves to make investing sound complicated. They use big words and fancy charts to make you think you need them. The truth is, many of those high-flying fund managers often fail to deliver results that justify their enormous fees. The Bogleheads, named after the legendary John Bogle, founder of Vanguard, figured this out a long time ago. Their philosophy is refreshingly straightforward. Invest in broad market index funds, keep your costs incredibly low, and stay the course for the long haul. Alright, so what is this Boglehead thing I'm talking about? It's not some weird cult, I promise. It's a community of smart investors who follow the principles laid out by John Bogle. His big idea was revolutionary but also incredibly simple. Most active fund managers don't beat the market over time, especially after you subtract their high fees. So why pay someone a fortune to underperform? It just doesn't make good financial sense, folks. The core philosophy of Boglehead investing is built on a few key pillars. First, it's about recognizing that trying to outsmart the market consistently is a fool's errand for most people, including many professionals. Instead of trying to find that one needle in a haystack, the winning stock, Boglehead suggests buying the whole haystack. This means investing in broad, diversified index funds that track an entire market segment, like the S&P 500. Another huge part of the Boglehead way is an obsession with keeping costs low. Fees are like termites for your investments. They silently eat away at your returns over time. Now let's talk strategy, the nuts and bolts of how Bogleheads actually invest. The cornerstone, as we've touched on, is the use of low-cost, broad-market index funds. Think of an index fund like a basket that holds tiny pieces of many different companies. For example, an S&P 500 index fund holds shares in the 500 largest US companies. By buying this one fund, you get instant diversification. Simplicity is another key strategy. You don't need a complicated portfolio with dozens of different funds. In fact, for many people, a simple 3-fund portfolio can be incredibly effective. This typically includes a US total stock market index fund, an international total stock market index fund, and a US total bond market index fund. The allocation between these depends on your age and how comfortable you are with risk. Section 4, Getting Started, your first steps to Boglehead success. Okay, you're probably thinking, Dave, this sounds good, but how do I actually it? Great question. Getting started as a Boglehead is easier than you think. The very first step before you even think about investing a dime is to get your financial house in order. That means paying off high-interest debt like credit cards and personal loans. Build up a fully funded emergency fund too, 3 to 6 months of essential living expenses. Once your debt is under control and your emergency fund is solid, it's time to think about to invest. For most people, this means using tax-advantaged retirement accounts first. If your employer offers a 401k or 403b with a company match, contribute enough to get the full match. After that, consider a Roth IRA where your money can grow tax-free and you can withdraw it tax-free in retirement. These accounts offer significant tax benefits that can supercharge your long-term returns. Section 5, Shocker, things that actually work, and Wall Street won't tell you. One of the most surprising insights from the Boglehead philosophy, and something Wall Street doesn't shout from the rooftops, is that often leads to. The financial industry frequently encourages frequent trading, new products, and constant adjustments. Why? Because activity generates fees and commissions for them. But for you, the investor, all that churning can lead to higher costs, higher taxes, if you're investing outside of retirement accounts, and often worse performance. The Boglehead approach of buying good, diversified index funds and holding them for the long term is beautifully boring and beautifully effective. Another counterintuitive idea for many is that you don't need to be an expert stock picker to succeed. The idea that you can consistently find undervalued stocks or perfectly time the market is largely a myth for the average person, and even for many professionals. The Boglehead's guide shows that simply matching the market's return through low-cost index funds and keeping more of that return for yourself by minimizing fees is a winning strategy. It democratizes investing.